What? With the Strait of Hormuz opening and closing, gas prices going up, down, and sideways, mortgage rates bouncing all over the place, the stock market just going all over the place. Listen, don't stop thinking about tomorrow. It'll soon be here. Hey guys, it's your favorite mortgage guy, Steve here. It is Friday. You want to know something? It's been a great week this week. So let me start with your questions now. I'm going to try to make this fast today. I know last week was a long one. We had a lot of information to cover last week. But so starting with the question last week where if my goal is to buy in 2027, what steps do I need to take? So that was the question that someone posed to me. Well, then all of a sudden, now I'm getting email after email after email saying, what steps do I need to take? Guys, here's what I'm going to tell you. We need to go ahead and just get in touch with me and let me put you on a plan. I'm going to pull a soft pull credit report because I want to see what your score looks like, although it's not a hard pull, it's a soft pull, and it enables me to look at your score without it impacting the other scores. So if you want to get in line to get on a plan, then just call me and let's go. This question here, can I repair credit on my own? That has come up for the past 3 weeks, and it has hit hard. You know what? I'm going to tell you this. You can try to, but every single person that has done it, here 2 years later, they come back to me and said, I've tried to do this, tried to do that, and the score's gotten even worse. You need the help of a professional. I use a company called UQual. Yes, there's a charge to it. The average person gets their score up in 60 to 90 days. It's about $60 a month. I don't know, maybe $70 a month. But still, here's the problem. You're going to start trying to do it, and then 3 months later, you're going to get back on it again. Then 3 months later, now you're 6 months into what you said you were going to do. You never got it done, and your score has gotten worse. So that's why you need the help of a professional. I have a ton of equity. I need to pay off some debt. What do I do? I've tried using GPT. It's not a lot of help. Of course it's not. It's an algorithm. It's not going to help. You're not going to get a loan from GPT. You're just not going to get a loan from Chat or Grok or Copilot or any of these other ones out there. They're not giving loans out. There's no human being to call. Can't put in an application. You got to come with a professional like me. But listen, paying off debt. Listen, it's no secret. You can look at the statistics the government puts out. Right now, 37% of Americans are living off of credit cards. They're spending about $30,000 to $40,000. They've got jobs, but they won't stop putting it on the credit card. And all they're doing is paying the minimum payment at 24.9%. Next thing you know, wow, how did that interest grow that account that much? Well, there you go. 39 or 29% interest, 25% interest, 20% interest. What doesn't matter? One of those numbers, it's going to overwhelm you. So what I'm saying is give me a call and let's look at your equity. So moving on to a couple of other things, renovation loans, yes, call me. Refinancing, yes, call me. If you're hoping mortgage rates were going to give us a break this week, well, the bond market, it had other plans. This morning's S&P, the Global Services Report, I love that report. It came in much stronger than expected, signaling that the economy continues to grow at a pretty healthy rate. Here's the thing. When they're in a race to get the economy growing, it's important that they keep up with pace to preserve inflation so that it doesn't continue to grow. Normally, a strong economy is good news, but for mortgage rates, strong growth combined with stubborn inflation, well, that's exactly what we don't want to see right now. Now, you may want to see that for prices of goods and services and things like that, but if you're looking for mortgage rates, you don't want to see that. The 10-year Treasury, it's been testing some important resistance levels, while mortgage-backed securities, they're still under pressure. Now, the 10-year Treasury is the bond that we use to price out interest rates. Mortgage-backed securities is what replenishes the lenders because they sell it off into the secondary market. Now, on top of that, having rising concerns about government debt and the Treasury borrowing and energy prices, it's a concern. Your oil prices, your gas prices, your utility prices, they've gone up. Put it all together, and guess what? Mortgage rates being squeezed from all directions. So what am I telling my clients today? If you're under contract and you're comfortable with the payment, I would strongly consider locking the rate. This isn't a market where I'd gamble hoping to squeeze out another 1/8%. And remember, don't let one day's interest determine your 10-year housing decision, because most people make housing decisions based upon 10-year events, whether it's having children, children leaving the house, whatever it is. We can always attack the refinancing down the line, but you don't buy a house to refinance. When an opportunity presents itself, seize the opportunity to buy the house. Listen, houses aren't coming on the market like they used to. There's supply and demand issues. Will builders be able to buy us out of this or build us out of this market? Absolutely, they will. It's not going to happen overnight. It's going to take about 10 years. Buy the house, not the rate. Listen, I'm your favorite mortgage guy, Steve. I need your referrals. All of my information is along one of these sides here. If I'm guessing, I'm thinking it's over here, but I'm probably going to be wrong. Go to all my socials, friend me, like me, click the bell, whatever you need to do. Call me, text me. I'm here for you. Have a great weekend, guys.